Well, what is going on, guys? Luke here today, and there has been a huge uptick in people who are saying they are timing the market now, and per the usual, YouTube is not helping this at all. And this even permeated into my group last week, and we discussed it in a live stream and the Discord, but I wanted to make sure I address it here too, since if it's in my group, many of you probably had the same questions or maybe some of the same thoughts. So we will discuss timing the market, but more importantly, I want to give you an easy to follow strategy so you don't have to time the market or be stressed or anything else like that. I just ask in exchange for you to gently tap that like button and consider subscribing too. It's super easy to do if you like the truth without the hype. And are you against having a team of investors, including me, working directly with you on how to value a stock or find great stocks or even how to raise cash? If you're not against that, then you need to know the March Madness sale ends soon to join the Market Insiders private group, where you get full and direct access to me and a group of 6- and 7-figure investors, and you get access to 4 courses for free that teach you how to plan, do evaluation, build up your cash, and you get to see my watch list with price targets, my buy and sell alerts. We got live weekly Q&As, actually more than weekly now. We got a bunch of exclusive videos and a ton more, so check out the pinned comment. And before blasting me for promoting it, I have no ads, no sponsors. This is what YouTube pays me in a month, and I give half of that and half the group's proceeds to charity. All right, so we have had big YouTubers all over the place selling their stocks, jumping back in, selling again, and on and on and on. Now some are even sniping at each other, and many were buy and hold, and now are market timers and touting their strategies, and it's all just a mess overall. I don't want to rehash any of it or criticize any particular YouTuber. Each has their own motivations, their own reasons, and to be honest, it's their money and their audience. In the end, bashing them or trying to create controversy or whatever is not helpful to you guys as investors. So instead, I want to focus on the facts around timing the market, and I'll give you an easy strategy to follow. But let's clear up one thing first, as I've received a few comments over my last few videos. And the only reason I feel the need to talk about this is because I recommended his channel just a few videos ago. Chicken G did sell his stocks and said he was essentially timing the market per se, but not with his main fund. Instead, it was his itchy finger account, which is his trading account, and his main fund that holds the majority of his stock wealth remains untouched and in a buy and hold status. Now, I personally do not have a trading account. I have no desire to trade, but others do, and at his wealth level, he is not putting his wealth at risk by having $1 million plus trading account. Now, slow down, I agree with you. Yes, it's a lot of money, but he is not risking his wealth with it, and my guess is he doesn't recommend risking your wealth, but instead is going to recommend DCAing. But check out his channel for more details. I don't want to speak too much for him, but I know you guys were interested in my tank since I did recommend his channel. All right, so on to the facts around market timing. So let's do a little exercise here. Let's name some of the greatest investors ever. Warren Buffett, Peter Lynch, Benjamin Graham, T. Rowe Price, the Tesla bull. I don't remember any of them being market timers really. As a matter of fact, all of them have said the exact opposite, that you cannot time the market. So the greatest investors of all time all say don't do it, and it doesn't pay off over the long run. But hey, wait a second. What does the data say? I mean, data is what really matters, not opinions, even if they're from the goats of investing. Okay, well, let's take a look at the data. And when we look back at the data going back to 1930, if an investor missed the S&P 500's 10 best days each decade, the total return over 90 years would stand at 28%. Now, if on the other hand, you just held through the ups and the downs, the return would have been 17,715%. So over the long run, if you just happen to mistime your move and miss the best day only one day a year on average, so basically you can be perfect all the other days, but you just missed that one day, your return was insanely negative when you include inflation. I mean, you literally saw your wealth dwindle to nothing without all that effort and all that stress. That is a minuscule margin of error that has to be repeated over and over and over and over again, which honestly is impossible. But on the flip side, if you just bought and held and did absolutely nothing, your wealth grew exponentially with no effort whatsoever. Remember, investing is about risk versus reward, and over the long run, now not 1 week or 1 month or 1 year like many people are telling you, but over the long run, the comparison is not even close by miles, and buy and hold is the winner for investors. And for further clarity, I'm an investor who picked up YouTube late in life, not a YouTuber who makes content about investing and that is an important distinction to make in my opinion. Buy and hold is not sexy, it's not flashy, it doesn't give me 8 videos a day of content, so many YouTubers shy away from it. But it has proven over and over and over to be virtually unbeatable. The fact is, buying great companies at undervalued prices and just holding makes you a fortune in the long run, not jumping in and out of stocks, and here's my quick example of how I proved this out. A $2,000 investment in Apple after the tech bubble popped, now not timing the bottom, but completely missing it and watching it go lower for over almost a year after you bought, like I did, is now worth 7 figures today. All you had to do was buy $2,000 worth, forget about it, and you're a millionaire today. Let me repeat that. Just $2,000 is all it took to get there. No timing the bottom, which I didn't with that Apple investment. No getting in and out of the position and figuring out the runs and the dips, and in that real life example, you didn't have to put a dime in more into that investment. All you had to do was make the initial investment and hold, or buy and hold. So how the heck do you accomplish this in this sort of market? Well, it's quite simple, and here's the 3-step strategy to get there easily and with low stress. No fancy formulas, guys, or calculators, or $1,000 courses, which is just crazy and it still blows my mind. Heck, you can get 4 courses with a membership with me and it's like 29 bucks. I mean, you can sign up, do the courses and cancel. That's perfectly okay with me. And then you can invest the rest of that $1,000 you would have spent on the other guys' courses into stocks instead. All right, so here we go. Step number 1 is doing your due diligence. You must know what you own. Study the management team, the financials, the business model, listen to the earnings calls, study the competitors, and the market that they all serve. Due diligence takes days, weeks, and sometimes months before I feel comfortable investing in a particular stock. You have to put in the work. A 15-minute video is a nice primer or intro to a book if you want to kind of reference it to a book, but not actual due diligence, and it's not the same as actually reading the whole book. You just don't read the intro of a book and then don't read the rest of it. And all that takes me to step number 2. If you do your due diligence and you like what you see, you need to do a valuation so you know what is a fair value for that stock. It does you no good to love a stock, but not know if it's worth $20 or $60 or $5. Even great stocks have time periods of being way overvalued, way undervalued, and everywhere in between. But you cannot identify them without doing a valuation and then setting a price target. And since you know what is a fair valuation for that stock, put a price target on it, and so that way you can execute to it. And if you aren't comfortable with price targets, that's okay. Do your due diligence and then just simply DCA or dollar cost average into that great stock. Put it on a schedule and execute to that schedule. Buy as much as you can of these great companies according to your plan, and then hold for the long term because nobody can time the market. And then click this video right here for 9 stocks for you to consider adding that I have been adding heavily during this downturn. Check it out and see if they're right for you, or click the other video for the best YouTubers and their best stocks in my opinion. So thanks for watching, and we'll see you in the next one.